All right, fellow ape holders, XMAX Trading here. Looks like CNBC wants to give you some investment advice on trading during inflation. Although the stock market just took a tank today. But it's kind of interesting to see what they say. Not financial advice, just for entertainment purposes only. This investment, according to CNBC, this investment option can provide protection against inflation. If inflation is above what you're earning in treasuries, that part of your portfolio loses buying power. But there are other investments that can make up for it. So treasury, inflation protected securities, or TIPS, adjust to keep up with rising prices. Whether transitory or not, inflation has investors rattled. Many clients have brought up inflation as a concern, said Jimmy Lee, CEO of the Wealth Consulting Group in Las Vegas. They're hearing it all over the place, inflation. Inflation last month accelerated at its fastest pace in 13 years. Consumer Price Index rose nearly 1% in June. Largest one-month jump since 2008. 2008 was the year the market crashed, right? Labor departments and year-over-year surged 5.4%. Federal Reserve says price hikes are transitory and will fade as the economy recovers due to the economic shock of COVID-19. So yeah, I kind of agree with that because there were supply chain kinks or constraints because of factories shutting down and transportation shutting down. So yeah, prices for cars are shooting up, both used and new, and there's a constraint on car supplies, and there's a constraint on workers, perhaps. Housing prices have shot up, and I think at some point that's going to come down. So in my view, it's transitory. The inflation is transitory argument is starting to wobble, says Greg McBride, chief financial analyst at Bankrate.com. Supply chain disruptions, pent-up demand are more evident than ever, but there's still some base effect comparisons to last year that won't wash out for another couple of months. To that end, investors concerned about inflation eroding the value of their money may now be proactive when it comes to fixed income portion of portfolios. Best way is treasury, inflation protected securities. Like treasury bonds, TIPS are issued back to the U.S. government. Principal gets adjusted to reflect inflation, to keep up with rising prices. Unless, of course, the inflation thing dies down and then there's deflation, which Kathy Woods has been saying of ARK Investments. Benefit may be using short-term goals versus those years. Okay, so at least they're honest about that. The benefit is short-term. Hedging against possibility, inflation-reflected TIPS, backed by U.S. government, operate a bit differently, and depending on how to use them, you can help protect your purchasing power. Like treasury bonds, TIPS are issued by the U.S. government. Investors receive regular interest payments based on the so-called par value, the face value of the security until the security matures. At which point you pay back your principal. So it's like a loan. You're basically giving a loan to the government. However, TIPS come with inflation protection via yearly adjusted value that derives from the Consumer Price Index, which measures inflation. Changing yearly values is intended to maintain its TIPS purchasing power over time. But in contrast, treasury bonds may lose value over time due to inflation, unless the interest rate they earn is above that rate. Right now, the bellwether for 10-year treasury bonds is 1.6%, which means it could lose purchasing power if inflation hits even 2%. I don't think TIPS are good long-term for maintaining purchasing power. Oops, I'm not a fan of locking in 1.6% when that's below the Federal Reserve's inflation target of 2%. Maybe TIPS are not so good. He uses TIPS for short-term needs, up to 3 years. You have safety and protection, but not a good long-term investment. For, say, 10 to 15 years out, other investments, including dividend-yielding stocks, are generally better tools for beating inflation. TIPS aren't necessarily a great investment if you're in search of income because the yields are below non-inflation protected bonds. It's about protecting purchasing power. If there's no inflation, if there is no inflation, you won't realize the benefits of owning TIPS. Let's come back here. Let's see. For example, the investor buys 1,000 TIPS, 1%. Principal rise by $20. The rate will stay the same, 1%, but future payments now multiplied by the amount of 120. So the interest payment, $10 for the year, $5 every 6 months. What? Whatever. When TIP matures, you get paid back the principal or the adjusted principal, whichever one's greater. If you have considerable inflation, incorporating TIPS, you can feel better regardless of the outcome. allocation fixed income, but not full hedge. We can do better by adding other tools, such as commodities, high yield bonds, and equities. The goal is to design something you can stick with. Nothing is an all or nothing strategy. Yeah, makes sense, but I don't know. Tips. I like dividend stocks, not financial advice. Dividend stocks, maybe cover calls on dividend stocks or a dividend fund of some sort. So, well, interesting financial concept in our time. So check back for more videos, guys. Thanks. Bye.